Welcome to M&A in federal contracting. This training was built for practitioners, people who are either doing GovCon deals today, advising on them, or need to understand them deeply to serve their organizations well. Over the course of today, we are going to cover the full life cycle of a federal contracting acquisition. From defining the strategic thesis through identifying and screening targets, performing government-specific due diligence, structuring the deal to preserve federal value, navigating the novation process, and building an integration plan that actually delivers on the promise of the transaction. This is not a generic M&A course with a government overlay. Everything you will hear today is grounded in the specific rules, risks, and realities of the federal marketplace. The goal is simple. By the time you leave, you will be able to engage in a GovCon M&A process with confidence, catching the problems before they become expensive surprises and building the kind of value that takes years to replicate organically. This slide shows you both who this training is designed for and what you will take away from it. Looking at the audience column, you can see we have intentionally built this for a cross-functional group. Executives need to understand why M&A is a market access decision and how to evaluate growth alternatives. Business development and capture leaders need to connect deal strategy directly to pipeline. Operations and legal teams need to understand how contracts transfer, what novation requires, and what FAR compliance looks like in a transaction. Finance teams need to understand GovCon-specific deal structuring. And program managers need to understand how to protect contract continuity through a transition. The learning objectives on the right reflect all of those perspectives together. Whether you are the person running the deal or the person managing the contracts on the day after close, this material applies directly to your role. We will move through the content as a group, and I encourage you to bring your own experience into the room. The most valuable insights today will come from the intersection of this framework and your real-world context. Let me walk you through the agenda so you know exactly where we are headed. We start with Section 1, the GovCon M&A landscape, setting the context for why the federal market is unique and why M&A in this space requires a different playbook than commercial transactions. Section 2 covers strategic objectives, what buyers are actually acquiring when they pursue a federal contractor, and why the answer to that question is more nuanced than most deal teams assume. Section 3 is target identification, how to build a target universe from government data, and how to score and rank candidates with a structured matrix. Section 4 is due diligence, the 8 work streams that matter most in a federal deal and how each one differs from commercial M&A practice. Section 5 covers deal structuring, the asset versus stock decision, small business status considerations, SBA affiliation rules, and earn-out design for federal contracts. Section 6 is the novation process, how FAR 42.12 works in practice, and what happens to contracts when a company changes hands. Section 7 covers integration strategy, the 100-day federal integration plan, and how to turn a closed deal into competitive wins. Section 8 is the decision framework, the buy, build, team, or wait question, and the 5 tests for answering it. Section 9 covers the 11-step GovCon M&A process from thesis to measurement. Section 10 covers the key FAR provisions every M&A team needs to know. And we close with the most common mistakes in GovCon M&A and the management go/no-go checklist. Throughout the day, we have 3 workshop exercises where you will apply the frameworks to realistic scenarios. The federal government awarded $765 billion in contracts in fiscal year 2023. A record high, and $755 billion in fiscal year 2024. These are not abstract numbers. They represent the total accessible market for every federal contractor in this country. And how companies access that market has changed significantly over the past decade. Increasingly, the fastest path to a larger share of that market is not organic growth. It is acquisition. What is particularly interesting about the GovCon M&A market is how it performed in 2023. When the broader M&A market was down 25% due to interest rate pressures and economic uncertainty, GovCon M&A deal volume declined only 8%. That resilience is not a coincidence. Federal contracting revenue is relatively non-cyclical. Agencies continue to need services regardless of macroeconomic conditions. And strategic buyers, the companies making acquisitions to access vehicles, past performance, and cleared workforces, have longer time horizons than financial buyers. The result is a market that consolidates steadily, even when the rest of the deal world is quiet. The A&D/GovCon sector saw over $46 billion in deal value in 2022 alone. Understanding this landscape is the starting point for understanding why the skills in today's training matter. The most important concept I want you to take from this entire training is captured on this slide. Every GovCon acquisition is actually 3 separate deals running simultaneously, and they all have to finish together for the transaction to deliver its intended value. The first work stream is the corporate deal: valuation, legal structure, reps and warranties, closing conditions, and financing. This is what most deal teams do well. The lawyers focus here. The advisors focus here. And frankly, this is where most transactions succeed in isolation. The second work stream is contract transfer and compliance: the contract inventory and novation filing, FAR Part 42.12 compliance, small business re-representation, OCI analysis, and the operational reality of transferring federal performance authority to a new entity. This is where GovCon deals get hurt. A buyer can close a transaction on a Friday and discover Monday morning that 3 of their largest contracts cannot be billed because the novation has not been executed. That is not a hypothetical. It happens regularly, and the revenue gap can last months. The third work stream is capture strategy: the pipeline opportunity mapping, the proposal asset audit, the customer communication plan, and the BD team integration. This is the multiplier. The best GovCon acquirers do not simply preserve what they bought. They use the acquisition to win new work immediately. The real return on investment in a federal acquisition comes from the first pipeline win that uses the acquired past performance or vehicles. The question to keep in mind as we go through the rest of today is, in your organization, which of these 3 work streams is the strongest, and which one represents the biggest gap? We are now moving into Section 1, Strategic Objectives. Before we talk about how to execute a GovCon acquisition, we need to be very clear about why a company would pursue one. In my experience working with federal contractors, most organizations can describe their M&A interest in general terms. They want to grow revenue, expand capabilities, enter new agencies. But the best acquirers think about this very differently. They do not start with a deal. They start with a specific federal outcome they cannot achieve organically at the speed the market requires. That framing changes everything: which targets you pursue, how you structure the deal, how you integrate the company, and how you measure success. Over the next several slides, we are going to break down exactly what GovCon acquirers are actually buying, using 4 concrete strategic objectives. By the end of this section, you should be able to articulate a clear, specific acquisition thesis, one that goes well beyond revenue growth and connects directly to named federal opportunities. Many agencies in the federal government buy through existing contract vehicles rather than open market competitions. If you are not on the vehicle, you simply do not get to compete, regardless of how strong your technical solution is. That is the fundamental reason companies pay acquisition premiums for targets that hold government-wide acquisition contracts, or GWX. The slide shows the major vehicle types. A GWAC like Alliant 2, OASIS, or CIO-SP3 is a broad-scope multi-agency contract that gives the holder access to task order competitions across the federal enterprise. An IDIC is typically agency-specific but can carry large dollar ceilings. A BPA is a pre-negotiated arrangement with a GSA schedule holder. A MAC is a multiple award contract where selected awardees compete for task orders. An SUP is a NASA-managed IT procurement vehicle. The critical point here is that holding a vehicle is not enough. The question you must ask in any target evaluation is whether the vehicle has remaining runway, relevant scope, and enough ceiling to justify the premium. Consider a target that holds an Alliant 2 position, which sounds very attractive, but the vehicle expires in 14 months and has only $3 million of ceiling remaining. How much value does that position actually represent? Close to zero. Yet buyers routinely pay vehicle premiums without checking these details. As part of due diligence, you need to map every vehicle the target holds, confirm its ceiling, confirm its scope, and confirm when it expires or recompetes. CPARS ratings, the Contractor Performance Assessment Reporting System, are the government's official scorecard for contractor quality. A strong CPARS history is often cited as one of the primary reasons to acquire a federal contractor, and it can be a genuinely valuable asset. But there is a trap here that catches many buyers. A CPARS rating tells you that quality was delivered. It does not tell you whether that quality is relevant to your proposals. To determine whether acquired past performance will actually help you win new work, you need to apply 3 tests. The first test is recency. Federal agencies typically evaluate past performance from the last 3 to 5 years. If the target's best ratings are from work done 6 or 7 years ago, evaluators may not score them. The second test is relevance. Does the work align with the agency's NAICS codes and mission areas you are targeting? A Navy CPARS does not help you on an HHS bid. A CPARS from a decommissioned platform does not help you on a modernization competition. The third test is translatability. Can your proposal team tell this story convincingly? Do you have the people, the relationships, and the context to frame this past performance credibly in a source selection? If you cannot pass all 3 tests, the past performance you are acquiring may look impressive and deliver very little in practice. This is one of the most common overvaluations we see in GovCon M&A, and it is entirely preventable with disciplined pre-close analysis. The third and fourth strategic objectives, technical capabilities and new agency access, are closely related, and both require careful analysis before you assign them value in a deal. On the capabilities side, the most compelling acquisition cases involve capabilities that are genuinely difficult or slow to build organically. Cybersecurity operations, DevSecOps delivery, cleared engineering teams, and facility clearances fall into this category. Consider cleared personnel specifically. It can take 18 months or more for a new employee to receive a top-secret clearance. For a company trying to move into national security work at speed, acquisition of a cleared workforce may be the only viable path. The build or buy test is straightforward. Could we hire or develop this capability in 12 to 18 months at a reasonable cost? If yes, the acquisition premium may not be justified. If no, the acquisition case becomes much stronger. On the agency access side, the key distinction is between institutional relationships and personal ones. Institutional access is embedded in contracts, vehicles, and agency workflows. It persists through personnel changes. Personal access exists in an individual's Rolodex and professional network. If a target's primary value proposition is the founder's relationships with a specific set of agency leaders, those relationships can walk out the door the moment that person retires or moves on. The question to ask in every due diligence process is, if the founder left tomorrow, what would remain? The answer tells you how much you are actually buying. The Peraton acquisition of Perspecta in 2021 is one of the most instructive case studies in modern GovCon M&A. At a deal value of $7.1 billion, it was also one of the largest. In 2020, Peraton was a solid mid-tier federal IT contractor. But when the company evaluated its competitive position for large enterprise IT programs, the kind of programs worth hundreds of millions or even billions of dollars, it was not in the conversation. Too small. Insufficient vehicle access. Not enough cleared workforce scale. So rather than trying to grow organically to compete with Lidos, GDIT, and Booz Allen, Peraton made a different choice. CEO Stu Shea stated directly, "We could not compete at scale on the IT side." The Perspecta acquisition was the solution. Perspecta held Alliant 2 large business and CIO SP3 positions, and the combined entity was significantly better positioned for the successor CIO SP4 vehicle, a $40 billion opportunity. The combined company brought together a $24.4 billion backlog, 22,000 employees, and 7,500 personnel with top-secret SCI clearances. The key lesson from this deal is one I want you to carry through the entire training. Always trace M&A rationale to named pursuits. Not we want to grow in national security in general, but specifically we want to win CIO SP4, SEUP 6, and the DIA enterprise contract, and this acquisition gives us 3 of the 4 requirements to be competitive on all 3. That level of specificity is what separates thesis-driven acquisitions from deals that are hard to measure and harder to defend. We are moving into Section 2, Target Identification. Now that you understand what you are buying, vehicles, past performance, capabilities, agency access, the next question is where to find it. Most M&A processes in GovCon start with an investment banker presenting a target. That is not wrong, but it is reactive. The best acquirers we work with do not wait for a banker's pitch book. They build their own target universes from the ground up, using government data that is publicly available and remarkably detailed. USS spending, FPDS, SAMSER, these are not just reference tools. They are competitive intelligence platforms. In this section, we are going to cover what to look for in a target, how to score and rank candidates using a structured matrix, and where to find them. By the end of this section, you will have a repeatable research methodology that you can apply starting tomorrow morning. The difference between good acquirers and great ones in this market is not access to information. It is methodology. Each of the 6 screening criteria on this slide requires a more sophisticated read than it might appear at first glance. Active federal contracts is the most obvious criterion, but the most dangerous one to evaluate superficially. The key metric is not total contract awards, it is funded backlog. Remaining funded task orders, option periods, and the recompete probability tell you what you will actually be paid going forward. Headline award values are frequently misleading. Strong CPARS ratings matter, but only if they are relevant, recent, and tied to the specific work your proposals need to reference. Agency relationships must be distinguished carefully. Institutional relationships embedded in vehicles and contracts have lasting value, while personal relationships built on individual rapport are fragile. Small business status is a critical valuation input. If you are a large business acquiring an SDVOSB or an 8A firm, you need to understand precisely how much of that firm's current revenue is set-aside work, because that eligibility may not survive the transaction. And the clearance profile matters both at the individual level, where specific cleared personnel need to be retained, and at the entity level, where facility clearances have their own transfer requirements. The overarching principle for all 6 criteria is this. The most dangerous number in any GovCon deal room is the headline award value. It tells you what someone was paid to do once. It tells you nothing about what you will be paid going forward. This matrix is one of the most practical tools we use with clients. Its purpose is to take the subjectivity out of early-stage target evaluation and make scoring defensible when you present a recommendation to a board or investment committee. The structure is straightforward. You score each target on 7 criteria, weight those scores according to the priorities shown, and produce a total weighted score. Any target scoring 4.0 or above warrants deeper engagement. Any target below that threshold should either be passed or reconsidered with a clear explanation of which criteria hold the score down. The weights reflect the relative importance of each factor in determining whether acquired value will actually transfer to the buyer. Contract value and backlog quality and past performance each carry 20% weight because they are the most direct indicators of near-term revenue sustainability. Vehicle access and agency relationships each carry 15% because of their strategic impact on pipeline. And capability fit, small business status, and compliance risk each carry 10%. What I want to emphasize about the matrix is what it forces you to do. See the whole picture at once rather than fixating on the 1 or 2 metrics a seller most wants you to focus on. A company can look exceptional on revenue and terrible on vehicle access, excellent on past performance and high risk on compliance. The matrix surfaces those trade-offs before you commit emotionally or financially to a deal. In Workshop Exercise 1, you will use this matrix on a realistic hypothetical target. The target looks attractive at first read. Your job is to find why the score is lower than the surface suggests. Every data source on this slide is publicly available and free. The difference between companies that build excellent target pipelines and those that do not is not access. It is knowing how to use what is already there. SAM. Gov is your starting point. You can filter by NAICS code, state size standard, and socioeconomic certification to build an initial candidate list in minutes. USA spending. Gov is where you separate the storytellers from the performers. A seller can tell you they hold a $50 million contract. USA spending will show you whether they actually performed against it, or whether the funded performance was $8 million over 3 years while the ceiling sat largely unused. That is the difference between a healthy backlog and an empty ceiling. FPDS gives you contract-level detail, every modification, every audit history, every deobligation. If a target received a cure notice or had a contract terminated for convenience, FPDS shows it. The CPARS portal allows prime contractors to access past performance ratings, which is an important pre-engagement research tool. And commercial tools like Bloomberg Government and GovWin provide market intelligence, bid history, and pipeline tracking that help you understand how a target competes, where they win, and where they struggle. The research methodology that works best starts with your own federal growth thesis. the specific agencies, vehicles, and mission areas you need to access, and works backward through these data sources to identify who holds what you need. That discipline is what separates a focused target search from a random walk through deal flow. This is workshop exercise 1. You have 15 minutes to work in pairs or small groups and apply the scoring matrix to the hypothetical target described on the slide. TechServe Federal LLC. Read through the target profile carefully before you begin scoring. An $18 million annual revenue firm, NAICS Code and Computer Systems Design, with 2 active IDIC task orders, a GAWAC position on Alliant 2, 3 CPARS ratings, SDVOSB certification, a clean SAM record, and 8 employees with secret clearances. Score each of the 7 criteria on a 1 to 5 scale, compute the weighted total, and determine whether TechServe Federal meets the 4.0 threshold. Be prepared to explain your scores, particularly the ones where your group debated the right answer. The most important learning in this exercise comes from the disagreements, not the consensus. When you have finished scoring, think about what additional information would change your answer. Dead out, and in what direction. We are moving into Section 3, Due Diligence. You have identified the target. You have run it through the screening matrix. Now the question is, what are you actually getting? Due diligence in GovCon is not the same as commercial M&A diligence. Commercial diligence focuses primarily on financials, legal review, and market position. Those are still important here. But in a federal contracting acquisition, there are additional work streams that are unique to this market. And the ones most commonly skipped are the ones that produce the most expensive surprises. The goal of GovCon due diligence is not to find a reason to kill the deal. It is to determine exactly what you are buying, identify what is fragile, and price the transaction correctly. If you discover that $12 million of a target's $40 million backlog is at high risk of not transferring, that information should change your offer price, or at minimum, your deal protections. We are going to cover 8 due diligence work streams. Some will feel familiar. The ones that feel new are the ones most likely to save you the most money. SBA affiliation is one of the most misunderstood concepts in GovCon M&A, and it can affect deal value even before the transaction closes. The core principle is this: SBA does not look at labels. It does not care what the org chart says, what the purchase agreement says, or how ownership is structured on paper. It looks at who actually controls the business. Through ownership patterns, management overlap, contractual dependencies, and economic relationships. And if it finds control, it aggregates the revenue and employee counts of all affiliated entities to determine size. The 4 affiliation triggers on this slide are each worth understanding in depth. Common ownership means that if a buyer holds a majority stake, minority stake with certain rights or options to acquire a controlling position, SBA may aggregate the buyer's and target's revenues and employees together, potentially disqualifying the target from small business status. Common management means that overlapping officers, directors, or managing members between the buyer and target can trigger affiliation even without majority ownership. Shared C-suite representation or board seats are the most common examples. Contractual control features are particularly important in the GovCon context. Teaming agreements, joint ventures, or licensing arrangements that give the buyer effective operational control before close can create affiliation before any legal transfer of ownership occurs. And economic dependence is the scenario that catches many buyers by surprise. If a target currently derives more than 70% of its revenue from the buyer acting as a prime contractor, SBA may determine affiliation exists based on that economic relationship, even if the 2 entities have completely separate ownership structures. This means companies that have been teaming with a target for years need to run an affiliation analysis before any acquisition discussion becomes serious. Earnouts are a common mechanism for bridging valuation gaps in M&A. The seller believes the company is worth $25 million. The buyer's analysis supports $18 million. An earnout allows the seller to receive additional consideration if the business hits agreed-upon targets after close. In commercial M&A, this can work reasonably well. In GovCon, earnouts based on revenue targets are a reliable source of post-close disputes because the federal revenue environment is full of variables that neither party can fully control. Let me walk through how a typical earnout dispute unfolds in this market. 12 months into the earnout period, revenue is below target. The seller calls you frustrated. You explain that 3 task orders were deobligated, an agency decision outside either party's control. The seller says you did not pursue them aggressively enough. You explain that the key program manager who came with the deal left for a competitor at month 8. The seller says the transition plan was inadequate. Both arguments have merit. Neither can be easily resolved without specific contractual language that defines in advance which events excuse performance and which do not. The solution is to engineer earnouts around federal realities rather than commercial deal templates. Tie metrics to funded task orders that were obligated before close, not to ceiling awards or proposal submissions. Use collectible revenue as the base. Cash actually received from specifically identified contracts. Define attribution clearly so both parties agree in writing on which contracts count toward the metric. And cap the earnout as a percentage of purchase price. We recommend below 25% to limit the total exposure to post-close disputes. These design principles will not eliminate all earnout tension, but they will dramatically reduce the ambiguity that drives most of it. We are now in Section 5, the novation process. This is the part of GovCon M&A that is most unique to the federal market, and the part most consistently underestimated by deal teams coming from commercial backgrounds. I want to start by correcting a very common assumption. When a government contract is transferred in an acquisition, it does not transfer automatically. The government does not have to recognize the buyer as the successor contractor unless the buyer formally requests that recognition. Contract by contract, agency by agency, and the relevant contracting officer approves it. What that means in practice is this: you can close a deal on a Monday. By Tuesday morning, the buyer may not be legally authorized to perform on the majority of those contracts. Not because anything went wrong legally, not because the deal was poorly structured, but simply because the novation packages have not been approved yet. Understanding this reality is not optional for anyone who touches federal contracting. The novation process under FAR Subpart 42.12 is what governs contract transfer in federal acquisitions, and we are going to walk through it in detail. Let me make this regulation feel real with a story. A technology company acquired a smaller federal contractor through an asset purchase. The deal lawyers certified the transaction was complete. The integration team began onboarding. On day 3, a program manager called the contracting officer to introduce herself as the new company's representative. The contracting officer responded, "I do not know anything about a new company. My contract is with the old entity. You cannot bill me until a novation agreement is executed." The work that had been performed in the first 3 days went unbilled for 6 weeks. The company lost significant cash flow. The contracting officer relationship was strained, and it all could have been prevented by understanding FAR 42.12 before the deal closed. The slide breaks down the 6 key elements of this regulation. The most important threshold question is whether novation is even required. Asset purchases, where a third party acquires the assets used to perform a contract, require novation because a new legal entity is performing. Stock purchases generally do not require novation because the legal entity, the government's counterparty, does not change. The novation package itself requires a specific set of documents: the purchase agreement, a list of all affected contracts, evidence that the successor has the capability to perform, legal opinions from both sides, and financial statements. The contracting officer reviewing that package may approve it, request additional documentation, or decline it entirely if performance risk is unacceptable. Assuming pre-close that government approval will be granted is dangerous. On timelines, simple novations on straightforward contracts can take 4 to 8 weeks. Complex portfolios spanning multiple agencies and involving classified contracts can take 3 to 12 months or longer. That timeline must be factored into your financial model and your transition service agreements. Let me walk through these 6 steps the way they actually feel on a deal team, not just how the regulatory text describes them. Step 1 is identifying every contract that requires novation. This sounds simple, but it is often the hardest step in the entire process. Sellers frequently do not have clean contract inventories. You are often piecing together a picture from SAM, FPDS, invoicing records, and conversations with individual program managers. Allocate a full week for this step, and do not assume the seller's list is complete. Step 2 is assembling the novation package. This is a legal document package, and you need a GovCon attorney who has assembled hundreds of these, not someone doing it for the first time on your deal. The quality of this package directly affects how smoothly and how quickly contracting officers process the novation. Step 3 is submission to each contracting officer separately. There is no government-wide submission that covers all agencies. Each CO must be approached individually. Prioritize contracts with the highest funded value and the closest billing cycles. Step 4 is the government review period, and this is where deals stall. The CO may request additional documentation, conduct a performance risk assessment, consult SBA if small business status is affected, or simply take longer than expected. Build 30 days of buffer per contract for this step in your financial model. Step 5 is the execution of the novation agreement itself, the three-party agreement signed by the transferor, the transferee, and the government. Until this agreement is signed, the buyer cannot legally perform on that contract. Circle the execution date on your integration calendar. It is a real milestone with real cash flow implications. Step 6 is the most commonly forgotten. Update your SAM registration and entity records immediately. I have seen companies complete novations beautifully and then have billing disputes for weeks because the SAM record still reflected the old entity name. Assign someone to SAM updates on close day. We are entering Section 6 integration strategy. The deal has closed. The novation packages are filed. And now, as many practitioners will tell you, the real work begins. Integration is where the acquisition thesis either becomes operational reality or quietly fails. In GovCon, integration failure does not typically look like a dramatic collapse. It looks like a slow bleed, a contract that was not recompeted aggressively, a customer relationship that cooled because communications were mishandled in the first 30 days, a proposal that lost because the acquired past performance was not integrated into the capture process in time. The critical mindset shift for GovCon integration is this. Most integration playbooks are organized around minimizing disruption. Combining systems, harmonizing HR, consolidating vendors. That is fine for commercial deals. In GovCon, that mindset alone will cost you value. The organizing principle for a federal integration is different. Integration is a capture strategy. Every decision in the first 100 days should be evaluated against one question. Which deals in our pipeline can we win now that we could not win before close? Contract continuity is the minimum bar. Winning new work using acquired capabilities is the thesis. The first 100 days of a GovCon integration determine whether you keep what you bought and whether you start building on it. Let me walk through the 3 phases. In days 1 through 30, the priority is to stabilize and communicate. The first call you make on the morning after close is to the contracting officer on your highest value contract, not to introduce yourself socially, to confirm that the novation package is filed and to provide a single point of contact for any questions. That call takes 5 minutes and prevents weeks of uncertainty for the customer. Execute key personnel offer letters on day 1, not day 30. Retain the people who make the contracts work before they have time to consider other options. Notify all contracting officers, primes, and critical subcontractors within the first 2 weeks. File novation packages for your top 10 contracts by funded value. And communicate to every agency customer in plain terms, same team, stronger company. No surprises. In days 31 through 60, the focus shifts to integration and acceleration. Complete the remaining novation filings. Integrate your proposal teams and begin the past performance narrative audit. Identifying which acquired CPARs are ready to be cited in active proposals. Update your GWA profiles and capability statements to reflect combined offerings. Complete the OCI mapping of the combined contract portfolio, because new conflicts may have emerged that did not exist for either entity independently. In days 61 through 100, the goal is to win new work. Submit your first post-close bid using acquired past performance or vehicles. File any re-representation updates required under FAR 2.219-28. Brief leadership on a measurement of the M&A thesis scorecard versus actual results. The metrics that matter most in this phase are retained backlog percentage, novations completed on schedule, key staff retained, proposals submitted using acquired capabilities, and task order revenue growth. This slide maps the 8 work streams that constitute a complete GovCon due diligence process. Commercial M&A diligence typically focuses on legal review, financial statements, and market position. Those correspond roughly to work streams 3, 7, and portions of 6 here. The 4 work streams that commercial buyers most consistently underweight, and where GovCon deals most often get hurt, are compliance review, OCI analysis, security and personnel, and small business status. These are not in a standard commercial diligence checklist. If your team is using a commercial template for a federal contracting acquisition, you are missing critical risk areas. On sequencing, the order in which you run these work streams matters as much as running them. OCI analysis should happen first. Before you look at the financials, before you model the valuation, before you develop any emotional investment in the deal. The reason is simple. If the OCI exposure is disqualifying, nothing else matters. You will have saved weeks of advisory fees by finding the fatal flaw early. Contract review and small business analysis follow closely. Financial and legal diligence come next, once you have confirmed there is no structural deal breaker in the GovCon-specific work streams. The question I encourage you to ask honestly right now is, which of these 8 work streams does your organization currently feel least prepared to execute? That answer identifies your biggest due diligence gap. A buyer once acquired a defense contractor with what looked like a strong IDIQ portfolio. 5 active task orders, good funded backlog, recent CPARS ratings. What the diligence team did not examine carefully enough was the key personnel clauses embedded in 3 of those 5 task orders. Each clause named the founder specifically as a required program manager. The founder left 6 months after close. Within 18 months, 2 of those 3 task orders were either modified or terminated. The buyer lost $8 million in revenue they had modeled as stable, contracted backlog. Key personnel clauses are among the most dangerous terms in a government contract, and they are often buried in the contract body rather than highlighted in the deal summary. The contract review workstream needs to surface every such clause before pricing. Beyond key personnel, you are looking for change of control provisions that require government consent before the transaction closes, prime versus subcontract distinctions because subcontract-heavy revenue may be restructured by the prime post-close option periods, and recompete timelines which affect the durability of the revenue model, termination language, and cure notice history, which signal performance risk, and the history of any contract claims or disputes which indicate relationship friction with contracting officers. The framework for this workstream is a detailed contract inventory. Every contract, every agency, every funded amount, every option period, every expiry date, and every clause that affects transferability. Build that spreadsheet in week 1 of diligence. It is the foundation for everything else. I want to tell you about an acquisition that never happened. A company spent 3 months in diligence on what appeared to be a perfect strategic fit. Great contracts, strong past performance, relevant capabilities, aligned NEX codes. The deal team was 3 weeks from signing the purchase agreement. Then outside counsel ran an OCI analysis. The target held an advisory contract at a federal agency where the buyer wanted to compete for a $200 million IT modernization contract. The target had helped draft the technical requirements for that competition. That is biased ground rules OCI, the most severe category, and it is disqualifying. The deal collapsed on a Friday afternoon. $2 million in advisory fees gone. The target was otherwise excellent. The OCI was not discoverable from financial statements or a standard legal review. It required someone who knew to ask specifically about the target's advisory and systems engineering work at the agencies the buyer wanted to pursue. There are 3 categories or advisories of OCI under FAR Subpart 9.5. Impaired objectivity arises when a company has a contract to evaluate or oversee work that the combined company now performs. Unequal access arises when the target obtained non-public information through an advisory or systems role that would give the combined company an unfair competitive advantage. And biased ground rules, the most serious term, arises when the target helped draft the very requirements the buyer wants to bid on. The one principle that should govern every deal team: obtain a written OCI analysis opinion before any emotional or financial commitment to the transaction. Not before LOI signing, before the internal conversation about whether to pursue the deal seriously. Every week you wait costs you more. If you have a strong accountant on your diligence team, that is a real asset. But if that accountant has not worked extensively with federal contractors, there are 5 things they will almost certainly miss. And those 5 things can amount to millions of dollars of valuation error. The first is the funded backlog distinction. A target may report $50 million in active contracts. That headline number means the government awarded $50 million on paper. What matters is how much of that has been funded in task orders, how much has already been performed and billed, and what remains collectible. In many cases, the collectible funded backlog is a fraction of the headline award. The second is DCAA accounting compliance. If the target performs cost-plus contracts and does not have a DCAA audited accounting system, you have just found a significant integration cost item. Getting an accounting system into DCAA compliance takes 12 to 18 months and meaningful resources. That cost needs to be reflected in the purchase price. Third is indirect rate structure. Indirect rates that are unstable or have been questioned by DCAA are a pricing risk that does not appear in standard financial statements. Ask whether rates have been audited, whether they have been questioned, and what the trend looks like over the last 3 years. Fourth is customer concentration. In federal contracting, a single agency revenue concentration above 40% is high risk, especially if that agency relationship is personal rather than institutional. And fifth is working capital timing. Government billing cycles run from 30 to 90 days, creating cash flow timing issues that are distinct from commercial receivables. Model these dynamics explicitly in your valuation. This checklist represents the minimum standard for a GovCon due diligence process. Every item on this list should be checked before signing. If any item cannot be answered, that is not a reason to skip it. It is a risk that must be bounded, either through contractual protection or pricing adjustment. Looking at the 3 columns, the contracts column covers the core contract inventory work. Active contract list, change of control provisions, novation requirements, key personnel clauses, option period calendaring, and claims history. The compliance and small business column covers the government-facing representations and certifications, socio-economic flags, affiliation analysis, re-representation obligations under FR 52.219-28, and ethics disclosure history. The financials and OCI column covers funded backlog documentation, indirect rate structure, customer concentration, accounting system compliance, and the written OCI analysis. The sequencing I recommend in practice is run OCI analysis and the contract inventory snapshot in week 1 before you build any financial model. Run novation mapping and small business analysis in week 2. Run financial and legal diligence in weeks 3 and 4. And complete security clearance, verification, and compliance audit in week 5 and beyond. By the time you are doing detailed financial diligence, you should already know whether the deal has a structural deal breaker. Finding the OCI in week 5 means you burned 4 weeks of fees and management attention for nothing. This checklist is your floor, not your ceiling. But if every item on it is addressed, you have done better than the majority of GovCon buyers. We are moving into Section 4, Deal Structuring. You have identified the target. You have run thorough due diligence. You know what you are buying and what the risks are. Now comes one of the questions that deal teams most frequently get wrong. How do you structure this transaction to preserve the federal value you just worked so hard to find? In most commercial M&A conversations, deal structure starts with one question. What is the most tax-efficient approach? In GovCon, that is the wrong first question. The right first question is, which structure best preserves the contracts, the small business status, and the competitive positioning we are acquiring? Tax efficiency is a secondary optimization, not the primary driver. The fundamental insight of this section is that structure follows the federal value thesis. And the 2 most common deal structures, asset purchase and stock purchase, have radically different implications for novation, small business status, and liability that most deal teams do not fully understand until after the transaction closes. Let me walk you through both. Here is a scenario to make this concrete. You are acquiring a company with $30 million in active federal contracts. The seller wants an asset purchase for their own business reasons. Your tax team agrees it is the more efficient structure. What is the problem? An asset purchase likely triggers novation under FAR 2.12, because a new legal entity is performing the contracts. Novation is not automatic. It requires the government's affirmative recognition of the successor. If your largest contract is a DoD IDIQ task order worth $12 million and the contracting officer takes 4 months to process the novation, you have just created a 4-month billing gap. You have employees to pay, overhead to carry, and you cannot bill the government. That gap can threaten the financial viability of the integration. Stock purchases avoid this problem because the legal entity does not change. The government's counterparty remains the same entity, just under new ownership. The existing contracts stay in place without novation. But stock purchases carry all of the target's pre-existing liabilities. A disputed DCAA audit, a prior contract claim, an unresolved performance issue. You inherit it all. There is also a common misconception about SBA treatment in stock purchases. Even when the legal entity continues, SBA still evaluates control and economic reality to determine affiliation. A change in ownership can still trigger affiliation analysis, and the result may be loss of small business status even in a stock deal. The practical guidance: get your GovCon counsel and operations lead in the room before your deal lawyers finalize the structure. Structure is a GovCon operations decision first, not a finance and tax decision. I want to give you a number and ask you to think about what it means for a deal. Imagine you are acquiring a $20 million SDVOSB, a service-disabled, veteran-owned small business. 80% of their revenue comes from VA set-aside contracts. You are a large business. What happens post-close? The SDVOSB certification is gone. The veteran ownership requirement is gone. The VA set-aside access is gone. That means $16 million of annual revenue is no longer accessible at the same competitive positioning. You paid for a $20 million revenue company, and you are going to keep approximately $4 million of it, the non-set-aside portion. If your valuation model did not account for that destruction of set-aside value, you significantly overpaid. This dynamic applies across all the socioeconomic categories in the table. For 8A firms, SBA approval is required to continue program participation after a change of control, and in many cases, that approval will not come. For WASB and EdWASB certifications, the qualifying owner must retain unconditional ownership and management control post-close. For Hub Zone certification, the principal office location and employee geographic requirements must continue to be met. The trigger mechanism in most of these cases is the re-representation obligation under FR Clause 52.219-28. After a merger or acquisition, the surviving entity must re-represent its small business status. Contracting officers receive notifications. Relationships get scrutinized. Before you price any acquisition involving a small business target, you must map exactly which set-aside revenues survive and which do not, and adjust the offer accordingly. We are entering Section 7, the decision framework. We have covered a great deal of ground. Strategic objectives, target identification, due diligence, deal structuring, novation, and integration. Now I want to step all the way back and ask the question that should precede every one of those steps. Should we even be buying? The most disciplined acquirers have a framework for answering that question before they ever look at a specific target. Not after the banker presents the pitch book. Not after the CEO gets excited in a management meeting. Before any of that happens. The reason this matters is that most M&A processes start with momentum rather than analysis. A banker calls. The target sounds compelling. People start mapping synergies. The deal develops an internal constituency. And by the time anyone asks whether acquisition is actually the best way to solve the underlying problem, the organization is already emotionally and financially committed. The buy, build, team, or wait framework is designed to force that question early, when it is cheapest to answer it correctly. We are in Section 10, Common Mistakes and the Go/No-Go Checklist. Everything you need to avoid a serious error in GovCon M&A can be distilled into 10 patterns. These are not theoretical warnings. They are the actual mistakes we see repeated most often in deals that underperform or fail to deliver their intended value. Some of them involve significant financial losses. All of them are preventable with the frameworks we have covered today. As we walk through these, I want you to think about 2 questions for each one. Have you seen this? And going forward, what would you do differently to prevent it? Mistake 1, paying for contracts without testing transferability. A company paid $40 million for a firm with $50 million in federal contracts. 6 months later, $28 million of those contracts were either subcontract only in the final days of performance or on vehicles with under $1 million in ceiling remaining. They paid for the headline. They should have paid for the transferable funded backlog. The fix is to always ask, is novation required? Is the value funded? Is the ceiling actually remaining? Contracts on paper are not revenue in the bank. Mistake 2, assuming strong CPARS ratings automatically upgrade your proposals. CPARS only helps if the performance is relevant, recent, and can be credibly presented by your team. Confirm that the incumbent team will stay post-close before assigning proposal value to their ratings. Mistake 3. Treating small business status as static through a transaction. Run post-close affiliation and re-representation analysis before you price the deal. Status loss is value destruction, and it should be reflected in the offer. Mistake 4. Discovering OCI after you have become emotionally and financially committed to the deal. Run a written OCI analysis on your top 5 candidates before any valuation work or letter of intent. The most strategically compelling target may also create the worst conflict. Mistake 5. Running integration like a generic commercial deal. Federal integration must be organized around contract continuity and capture acceleration, not HR systems and IT consolidation. Mistake 6. Underestimating the novation timeline in your financial model. Factor 4 to 12 plus months of novation windows into cash flow forecasts and transition service agreements. Mistake 7. Missing key personnel retention until after close. Identify mission-critical staff in diligence and execute retention packages on or before day 1. Mistake 8. Failing to update SAM registration promptly after close. Inconsistent SAM data creates friction with contracting officers immediately and delays billing. Assign a dedicated SAM update owner on close day. Mistake 9. Pricing strategic value that may not materialize. Separate base value, supported by funded backlog and current cash flow, from strategic value that depends on the thesis playing out. Know which percentage of your offer price is in each category. Mistake 10. Never measuring the deal against its original thesis. Define 5 measurable indicators before close and review them honestly at 90 days, 6 months, and 12 months. If you do not measure it, you cannot learn from it. This checklist is the management filter that should be applied before any deal team recommends a transaction for approval. 7 questions. Every one of them must be answered before you sign. On strategy, which named opportunities become more winnable because of this specific deal? If your answer is general capability or scale, the thesis is too vague. Name the bids. Estimate the probability lift. On contracts, which prime contracts are affected by the transaction? Which need novation? Which are nearing expiry or facing a near-term recompete? Has the funded backlog been confirmed, not just the ceiling value? On small business, what socioeconomic statuses matter in the target's current revenue? What changes after closing? What re-representation obligations will trigger, and when? Has a formal affiliation analysis been completed with SBA counsel? On OCI, what current or future pursuits become conflicted because of this acquisition? Can mitigation or waiver realistically resolve those conflicts within the timeframe of your active bids? Have you received a written OCI opinion from qualified counsel? On people, write down the names of the 5 to 7 individuals who absolutely must stay for this deal to deliver its thesis. Do you have retention packages in place for each one? On systems, can your organization absorb the target's accounting, contracts, HR, security clearance, and proposal asset infrastructure without disrupting service delivery to existing customers during the transition? On valuation, draw the line on your offer price between the portion supported by stable funded backlog and the portion dependent on strategic assumptions that may or may not materialize. What is the percentage split? Are you comfortable with that ratio? If any of these 7 questions cannot be answered, that is not a reason to halt the deal. It is a specific action item to address before signing. The checklist is your floor. If every item is answered honestly, you are prepared. This is workshop exercise 2, the buy, build, team, or wait decision applied to a realistic scenario. You are the Chief Growth Officer of CivTech Solutions, a $120 million civilian-focused federal IT firm. Your 3-year plan calls for expanding into national security and intelligence community work. You have 3 options. Option A is acquiring ClearPath Federal, a $22 million IC-focused firm with 60 cleared personnel, active INSCOM and NGA task orders, no GWAC, a founder planning to leave 12 months after close, and an expected purchase price of approximately $35 million. Option B is building, recruiting 15 cleared professionals over 18 months, pursuing IC vehicles organically, and estimating $3.5 million in cost over 2 years with clearance processing timelines of 18 to 24 months per new hire. Option C is teaming, Forming a teaming agreement with ClearPath Federal on 2 or 3 specific IEC opportunities over the next 18 months, with no acquisition and an option to revisit acquisition later. Your task is to apply the 5 decision tests to each option, determine which you recommend, and explain what additional information would change your answer. Work in groups for 12 minutes. Be prepared to defend your recommendation with specific reasoning tied to the decision framework, not general instinct. This is Workshop Exercise 3 on Novation Planning. You are the integration lead and the deal closes in 48 hours. Your job is to complete this novation planning table for 5 hypothetical contracts and determine for each one, is novation required, what is the risk level, and what specific action is needed. Let me walk through what I want you to think about as you complete this table. For the Army IDIQ task order under an asset purchase with a CO consent clause, this is an asset purchase, and the contract explicitly requires government consent. What does that mean for novation, priority, and action? For the GSA mass task order under a stock purchase with no change of control clause, the legal entity is not changing. Does novation apply here? What should still happen operationally? For the HS subcontract under an asset purchase, the government does not have privity with subcontractors. Does FAR 42.12 apply? Is there something else to check? For the DHS IDIC expiring in 60 days under an asset purchase, you have a timing problem. Standard novation takes 4 to 8 weeks minimum. What does that mean for this specific contract? And for the NRO cost plus R&D contract under an asset purchase with security review requirements. This is your most complex scenario. Intelligence community contracts have additional clearance-related review requirements. How does that affect your planning? Take 10 minutes to complete the table, then we will debrief as a group. Before I give you the 8 principles, I want you to take 60 seconds and write down the one insight from today that surprised you most. The thing you did not know this morning that you know now. That is your personal takeaway. What I am about to give you are the 8 principles that anchor everything we discussed. These are the things you should be able to state clearly without notes when a colleague calls you about a GovCon deal. Principle 1, M&A is a market access decision, not a finance event. The best GovCon acquirers start with a specific federal outcome, not a deal. Define the thesis before evaluating targets. Principle 2, 3 work streams must run in parallel. Corporate deal, contract transfer, and compliance, and capture strategy. Weakness in any one work stream can destroy the expected value of the transaction. Principle 3, test transferability before pricing. Contract value is not the same as transferable value. Test novation exposure, CPAR's relevance, small business survivability, and OCI before anchoring on a number. Principle 4, OCI is a deal killer. Find it early. Run a written OCI analysis before emotional or financial commitment. The most strategically attractive target may also create the worst conflict profile. Principle 5, structure follows the federal value thesis. Choose asset, stock, or holdco based on what preserves the GovCon value you are buying, not just tax efficiency. Principle 6, novation is operational, not automatic. Government recognition of a successor is contract-specific and agency-specific. Plan for it, staff it, and build it into your integration model. Principle 7, integration is a capture strategy. The 100-day plan must prioritize contract continuity and bid acceleration. The real return on investment comes from new wins, not just preserved backlog. Principle 8, measure what you intended to buy. Define 5 measurable thesis indicators before close and review them at 90 days, 6 months, and 1 year. Adjust the integration strategy based on results. The references on this slide are not formalities. They are the actual sources you should consult when you encounter these issues in a real transaction. Let me highlight the most important ones for each scenario you are likely to face. For every deal involving any contract transfer, FAR Subpart 42.12 is essential reading. It is publicly available at acquisition. Gov. Every novation conversation will reference it, and understanding it in advance means you can have more productive conversations with your contracting officers. For any deal involving a small business target, FR Part 19 and Clause 52.219-28 are required reading alongside SBA regulations at 13, CFR Parts 121 and 125. These govern size standards, affiliation, re-representation obligations, and program-specific rules for A to A, SDVOSB, WOSB, and Hub Zone certifications. For any deal where OCI is a question, FAR Subpart 9.5 is the governing provision. Read it before any OCI analysis conversation begins so you understand the three categories and the available mitigation approaches. For market research, the GAO's government-wide contracting dashboards are the most authoritative and comprehensive overview of federal spending trends, updated annually and publicly available. U.S. spending. Gov and FPDS are active research tools your team should be using continuously, not just for M&A diligence. And the Neybor Consulting GovCon M&A Strategy Playbook, the expanded edition, is the practitioner guide behind this training. It includes detailed checklists, the full scoring matrix, the Novation workflow exhibit, and the complete appendices that support everything we have covered today. Those materials are available through Neybor Consulting for your reference and ongoing use. We have covered the full life cycle of a GovCon M&A transaction today, from understanding what you are actually buying, through finding and screening targets, running 8 work streams of federal-specific due diligence, structuring the deal to preserve the value you discovered, navigating the novation process contract by contract and agency by agency, building a 100-day integration plan organized around contract continuity and capture acceleration, applying the buy, build, team, or wait framework to decide whether acquisition is the right path. Following all 11 steps from thesis to post-close measurement, understanding the FAR provisions that govern every phase of the transaction, and learning the 10 most common mistakes so you never have to make them yourself. I want to leave you with one final thought. The federal contracting market is one of the most complex, relationship-intensive, and regulation-dense markets in the world. M&A in this market is not easy. But the companies that master it, that pursue acquisitions with disciplined theses, rigorous diligence, and execution that accounts for the unique realities of the federal marketplace, do not just grow. They build competitive positions that take years to replicate organically. The goal for everyone in this room is to be on the right side of that equation. Thank you for your time, your energy, and the expertise you brought to this conversation today. Neybor Consulting is here to be a resource as you work through real transactions. For advisory conversations, due diligence support, novation planning, or integration strategy, the door is open. 4 options, 4 fundamentally different paths. And in my experience, most organizations default to buy when build or team would serve them better, and default to wait when buy is actually urgent. Let me give you 4 quick examples of when each choice is right. Buy is the right call when the constraint is time-sensitive. The capability or asset cannot be built organically at the required speed, and the value is portable after close. A company that needs Alliant 2 access for a major recompete in 8 months and cannot get on the vehicle organically in time, that is a buy situation. Build is the right call when the capability is straightforward to recruit or develop. A 12 to 18-month runway exists, and the cost is lower than the acquisition premium. A company that needs 10 additional cloud architects for an HHS bid, recruit over 12 months for $2 million in compensation, or acquire a small cloud firm for $8 million. Build is the right call. Team is the right call when access is needed for a near-term specific competition, but a full acquisition would add too much risk or complexity. If you need specialized AI/ML past performance for one DHS opportunity, and a teaming partner already holds the CPARs, a teaming agreement may be the most efficient path. Wait is the right call when the deal thesis relies on vague synergy, customer concentration is high, key relationships are personal and not institutional, or compliance issues are not yet bounded. The 4 negative cases on the slide are equally important. Do not buy when the thesis is generic scale without identified pursuits. Do not build when clearances or specific vehicle access are needed faster than organic growth can deliver. Do not team when long-term strategic capability is needed and the partnership may not be repeatable. And do not wait when an urgent constraint exists and time is genuinely running out. These 5 tests are the decision framework in action. Each one is designed to surface a different dimension of whether an acquisition is the right choice. And each one must be answered honestly before serious deal engagement begins. The first test is whether there is a specific, identifiable growth constraint that M&A can solve. Not a general desire to grow, a specific blocker. No vehicle, no past performance, no cleared team, no relevant agency access. Something concrete that is preventing you from winning specific named work. If you cannot identify the specific constraint, M&A is solving a problem you cannot define. The second test is whether that constraint can be solved organically in 12 to 18 months at a reasonable cost. This test requires comparing the acquisition premium against the realistic cost and timeline of recruiting, teaming, winning a mentor-protege relationship, or competing for a vehicle on your own. If organic build is genuinely feasible, the acquisition premium may not be justified. The third test is whether the target's value is actually transferable to you. This is the due diligence question. Does the novation work? Does the past performance transfer? Does the small business status survive? Is the OCI manageable? A target that looks excellent in the abstract may score very differently when you apply transferability analysis. The fourth test is whether the target improves win probability on specific named pursuits in your pipeline. If you cannot map the target's assets to at least 5 named opportunities where your win probability meaningfully increases, the thesis may be too abstract to price and defend. The fifth test is whether the deal damages another part of your portfolio through OCI, affiliation effects, integration distraction, or customer relationship impacts. A deal that adds $10 million in revenue while creating a disqualifying conflict for a $100 million bid is not a good deal. All 5 tests must pass. We are moving into Section 8, the 11-step GovCon M&A process. Everything we have covered today, objectives, targets, diligence, structure, novation, integration, and the decision framework, now fits into a single repeatable process. This is your end-to-end playbook for every GovCon acquisition, from thesis definition through post-close measurement. I want to be direct about something before we walk through these steps. Most organizations execute 6 or 7 of the 11. They skip the ones that feel slow, uncomfortable, or unfamiliar. And those skipped steps are reliably where things go wrong. The 2 steps skipped most often are Step 1 and Step 5. Step 1, defining the thesis, gets skipped when a deal already has momentum. Everyone is excited and nobody wants to stop and write a thesis statement. Step 5, running GovCon-specific diligence before valuation hardens, gets skipped when there is financial pressure to get to a number. The result is that the team anchors on a price, then discovers a problem, and now the seller interprets any adjustment as bad faith renegotiation. We are going to walk through all 11 steps. As we do, I want you to honestly assess which ones you have skipped on deals you have been involved in, and which ones you will not skip going forward. Step 1 is defining the acquisition thesis in one precise sentence. A real thesis is not, we want to grow in cybersecurity. A real thesis is, acquire a DHS-focused firm with active task orders on a GWAC vehicle, CPAR's ratings in zero trust architecture within the last 36 months, to support our bid for the DHS CDM contract expected in Q2 2026. That level of specificity prevents you from pursuing the wrong targets and makes your eventual board recommendation easy to evaluate. Step 2 is translating the thesis into measurable screening criteria, a filter, not a wish list. Agency mix, contract types, vehicles needed, annual federal revenue range, remaining backlog minimums, set-aside status, clearance profile, labor model, customer concentration limits. Every criterion must be verifiable in public data before you make a single outreach call. Step 3 is building a target universe, starting broad. At this stage, the goal is recall, not precision. You want 20 to 50 candidates so you do not miss the right company by filtering too early. Use SAM, US suspending, FPDS, and market intelligence tools. Step 4 is rapid strategic triage, thinning the list to 5 to 10 candidates by removing targets that are too old, too concentrated, too subcontractor dependent, too conflicted, or too founder dependent. Step 5 is the most critical step in the process. Run preliminary GovCon diligence before the valuation hardens. Test novation exposure, re-representation issues, clearance dependence, contract scope fit, and OCI exposure before you anchor on a price. If you find a deal breaker at this stage, you have saved weeks of work and significant advisory fees. Step 6 is developing the value model, separating base value from strategic value. Base value is what the company is worth based on current cash flow and funded backlog, independent of your acquisition thesis materializing. Strategic value is what it is worth if the thesis plays out. Vehicle access is converted to wins, past performance improves proposal scores, agency adjacency generates new pipeline. Know exactly what percentage of your offer price reflects each category. Step 7 is choosing the transaction structure. This is a 3-person conversation: your M&A counsel, your GovCon operations lead, and your SBA specialist. If any one of them is absent from the structure decision, you are missing a critical perspective. Stock, asset, holdco, phased acquisition. Each has implications for innovation timing, small business status, and liability that must be analyzed in the specific context of the target's contract portfolio. Step 8 is negotiating with GovCon-specific deal protections. Your purchase agreement needs provisions that do not exist in standard commercial templates. A CPAR's material adverse change clause. If past performance scores decline materially between signing and close, what is the remedy? A key personnel retention provision, naming specific individuals by role in the agreement if the thesis depends on them staying. A contract loss indemnification clause, defining which party bears the cost if a major contract is terminated for convenience before close. And a small business status misrepresentation provision if the target's SAM representations were inaccurate, who carries the liability. Step 9 is planning novation and post-close communications before closing. The contract inventory, the stakeholder communications map, and the novation packages should all be ready to file on close day. Contracting officers, prime customers, and key subcontractors should not learn about the change too late or from the wrong source. Step 10 is closing with a 100-day federal integration plan already built and ready to execute. Not drafted at close, built and agreed to in advance, covering contract administration, billing, security, HR, BD and capture, proposal assets, and customer messaging. Step 11 is measuring whether the thesis is working. Define 5 measurable indicators before close and track them at 90 days, 6 months, and 1 year. Retained backlog percentage, novations completed on schedule, key staff retained, proposals submitted using acquired past performance, and win rate improvement on named pursuits. If you do not measure it, you cannot manage it, and you will not know whether to repeat this approach or change it on the next deal. We are entering Section 9, FAR implications. Every competitor you face in the GovCon M&A market has access to the same targets you do. The buyers who consistently acquire more value are the ones who understand the regulatory landscape better, because that understanding changes how they structure deals, how they sequence diligence, how they communicate with contracting officers, and how they price risk. The FAR provisions we are about to cover are not compliance obstacles. They are the rules of the game. Understanding them better than your competitor is a material competitive advantage. Buyers who know these rules learn them here. Buyers who do not learn them in the field, and the tuition is substantially more expensive. Let me walk through each FAR citation with the scenario that makes it real. FAR, Part 42 and Subpart 42.12. Picture a deal closing at 5 p.m. on a Friday. By 9 a.m. Monday, 3 contracting officers are calling, asking why they are receiving work orders from an entity they have never heard of. That is what FAR 42.12 is designed to prevent, and what happens when it is not properly followed. FAR, Part 15, Sections 15.304 and 15.305, you paid a significant premium for the target's past performance ratings. Now you are in a source selection, and the evaluator says this performance record does not meet our recency criteria. The ratings are 4 years old. Your premium has evaporated. That is FAR Part 15 in action, and it is entirely preventable with a proper past performance audit during diligence. FAR Part 19 and Clause 52.219-28, the merger closes. 60 days later, re-representation notifications go to every contracting officer. 3 of them call the program manager asking about the change. 2 become more difficult on the next option exercise. That is FAR Part 19 in real life. FAR Subpart 9.5. Your combined company wins a task order to assess a defense agency's IT architecture. BD celebrates. Your general counsel then identifies that you hold a delivery contract with that same agency, making your advisory assessment an impaired objectivity OCI. Protest risk. Potential disqualification from future work, that is FAR Subpart 9.5 in practice. These are not theoretical scenarios. They happen in real deals every year. The buyers who have read these slides will not be caught by them. These 4 FAR provisions are the ones with the greatest direct impact on deal decisions, and each applies to a different member of your deal team. FAR, Part 42 and Subpart 42.12, Novation and Change of Name, is the operational reality for your contracts and program management teams. Corporate lawyers may consider the deal legally complete at closing, but government recognition of who may continue performing and billing is a separate operational process that must be planned before close, not managed reactively after it. FAR Part 15, Past Performance Evaluation, is the provision that governs whether the past performance you acquired will actually improve your proposal scores. The buyer's question is straightforward. Is the target's performance recent enough, relevant enough, and mission-aligned enough to earn stronger evaluation scores on the specific competitions we care about? If not, the past performance premium in your offer price may be significantly overstated. FAR Part 19 and Clause 52.219-28, Small Business Value Preservation, matters whenever any portion of the target's value is tied to set-aside eligibility. The critical distinction is between what the target has won historically under set-aside vehicles and what the combined entity will be eligible to compete for going forward. Those can be very different numbers, and the delta directly affects the justifiable purchase price. FAR Part 9, Subparts 9.1 and 9.5, Responsibility and Organizational Conflicts, is an executive-level risk. Subpart 9.1 requires that government contractors remain responsible parties, and prior integrity or performance issues can affect future award eligibility. Subpart 9.5 is the OCI provision that can turn the most strategically attractive target into the most competitively damaging acquisition. Both require proactive analysis before the deal is priced, not after it is signed. The practitioner truth behind all four of these provisions is that most GovCon buyers use general corporate counsel who knows M&A law extremely well and GovCon regulatory nuance inconsistently. The best acquisitions we have seen have GovCon specialist counsel at the table from the letter of intent through the integration.